I think step one is to embrace the fact that venture capital, anywhere you do it, is very risky. Like if you do it in the US and known founders, or even if you invest after lots of other investors, still half the companies are just not going to work out and lose your money. And that's just how it is. Like it's really hard to build a successful business. So all of venture investing follows this power law distribution, where one, two, or three investments in the portfolio end up being worth more than everything else combined.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Peter Livingston with us. Peter is the founder and general partner at Unpopular Ventures, an angel syndicate investing across sectors in early stage startups. In this episode, we talk about how Unpopular Ventures got started, how they got the initial LPs, sourcing super early stage startups, what they look for in companies, being an early stage investor in companies like Zepto, Syndicate versus the VC model, how is the deal memo prepared, and a lot more. So without wasting any time, let's dive straight in. Peter, how are you doing? So good to have you in the podcast.
Doing great. Thank you so much for having me.
Yeah, it's my pleasure. And I went through Unpopular Ventures, and it's no longer unpopular, right? It's pretty big, and it has some incredible companies in the portfolio, some incredible LPs investing alongside you. And now you also have a rolling fund. So we're going to talk all about it. But to start with things off, I want to know your story and how you started Unpopular Ventures.
Yeah, well, happy to share. And thank you very much for the kind words and also making the time to chat with me. So my quick personal story is almost my whole career has been in startups or in things related to them. Early in my career, I went through a couple startups as what they call an operator these days. One, I was the third person in the company, the first non-founder. And another one after that, I was the founder CEO. And the first of those two companies I got very lucky with. It did really well. It's a company called iRhythm. It's a medical device company. They went public in 2016, are worth somewhere around 4 or 5 billion now. I haven't looked lately, but it's a pretty successful public company now. And then my second startup that I was the founder of was actually a complete disaster. We raised money from Kleiner Perkins and built a team and launched the product, but just everything went wrong. We had the team chemistry wasn't right. I think I picked too hard of a market. We couldn't find product market fit, and anyway, we had to shut the company down in the end. And the funny thing is, I actually learned way more from that failed startup than I did from the successful one. So even though it really sucked going through it, I'm grateful that I had both of these experiences because it's really formed a lot of my knowledge and mindset around startups in general and now investing in them. I started dabbling in angel investing in 2012. Started very small, all slow, invested in just a few of my friends' companies. Gradually ramped it up to the point that from 2014 to 2018, I decided to become just a full-time angel investor. And in that period of time, I just got out there, made about 150 personal angel investments through a variety of channels. Really wanted to learn a lot, and I just ended up getting very, very lucky, in large part because I got turned on to crypto in 2015. And it wasn't really called crypto then; it was just Bitcoin, and Ethereum was a new thing, and there were a few others. But I ended up with a very successful personal angel fund in a short amount of time that was liquid, which allowed me to keep doing this financially. But then, more importantly, it led to others, various friends, asking if they could invest with me, and that led me to creating Unpopular Ventures in 2019. Started as a syndicate on AngelList. Started very small again. The first year, we just invested about 5 million. And we've grown to the point now where we're almost 4 years into this. It's grown. We've invested over 53 million, which has grown into 154 million of assets under management because a lot of our investments have grown in value significantly. And it's not just me anymore. I have a number of other partners that I work with in varying capacities. And then we've been so fortunate to be able to invest in a lot of really great founders that have gone on to build at least, still early, but really successful trajectory companies. So I feel very lucky to be a small part of their journeys, along for the ride. And yeah, we call, you mentioned that, maybe not so unpopular anymore. We really believe the best opportunities come from going where no one else goes. And where that is changes over time. So some of the themes that we've invested in the past are now actually very popular. And sometimes we still invest in those, but we're always kind of looking for what's the new area where kind of the quiet is that others aren't looking. And oftentimes when we do those investments in our syndicate, where we put it in front of our syndicate angels, they're not popular. And we're just like any other VC where we're wrong all the time, but every now and then we get one and we're lucky and it really takes off. Anyway, realizing that was a long personal story, I should probably pause there and turn it over to you.
That was good. Yeah. Besides, like when you started investing and you had about 3 to 4 years of investing your own money as an angel investor, so you had your own track record. So based off of that, I believe your friends came along you, and then that's how the syndicate got started. And
Mhm.
did the LP, the number of LPs investing with you grow over time, or you initially got some good names to invest with you?
Yeah, well, it started with 20 friends who agreed to invest with me. And then, I went through so I'd been on AngelList as an LP for many years and went through a process where I reached out to a number of other LPs on there, said I wanted to get my own syndicate off the ground and invited them to back me and got probably 200 from that. And then as you go, as you start putting up good investments, the LPs kind of tell their friends about you and you get more. And then AngelList has various mechanisms to help you find more LPs on the platform there. And so yeah, we've now grown to, I think it's something around 3,600 LPs who follow us, and about 1,800 of them have actually made at least one investment with us so far.
Yep, that's great. And besides, since your entire thesis seems to be built around the fact that you're backing unpopular startups that are not already big, that are still in their very early stages, but then the problem is that how do you source these companies to pitch to you, because they're still unpopular, still very few people know
Mhm.
about them. So how are you sourcing these early winners? Because you don't just have to source them, but also pick out the winners from them, right?
Yeah, well, we really leverage our network in a big way. So the first thing that we do, we were actually the first to really do this in a systematic way on AngelList. It was a little bit innovative at the time. It's no longer innovative because now everybody does it. But we actually share carried interest on the investments that we do with anyone who helps us source these investments. So these can be LPs of ours, they can be portfolio CEOs, they can be friends. And if they do the work to help us find a great opportunity, and we invest together, then we share some economics with them. And very few VCs do this. And so because we've been really trying to give back to our community of friends and LPs and portfolio CEOs, if they help us be successful, we share that success with them. We end up seeing a lot of things first. People would rather send stuff to us where maybe they can share in economics rather than send it to someone who doesn't do that. So first of all, that helps. And then the people that really send us most of our great investments, some of them are friends or like some of the investments that just come from founders that I know personally. Uh, we get a lot of referrals from our LP base. I think actually the best source of referrals is our portfolio CEOs. Usually when someone is just starting out with a new company, the first people they ask for advice are the people that also have a company and are maybe a step or two further ahead than they are. And so founders of early stage startups end up seeing a lot of really promising companies that are brand new. And because they're in this, they kind of know what's involved in actually building a company. They tend to have pretty good judgment. So they're pretty good often at identifying which founders are strong or have good theses. So I find that they tend to be one of the best sources of deal flow for us. And then the other source of deal flow is friends at other venture firms or angels that have good deal flow themselves, and they just send it over to us. So that's
Absolutely.
it.
Yeah, you seem to be big on scouting from the get go, and it seems to have paid off big time, right? So do you have? I believe you invest across geographies and across sectors.
Mhm.
It means that you have scouts across the world, is it? And across different sectors, is it?
Yeah. Yeah, so I haven't run the numbers lately, but I think about half of our portfolio
Hmm.
is outside the US. It might actually be 60%. Um, and we really love emerging markets. We love Latin America, Africa, India, Pakistan, Southeast Asia, um, in large part because so the US market is very saturated, where for every new idea, there's usually 5 or 10 competitors that are all kind of doing the same thing. And in many cases, sometimes they're building like really important businesses, but most of the time they start off like as a very fringe or niche thing that because all the big businesses have already been very well funded in the U.S. and you really have to start on the outsides. Where I mean, sure, if depending on what it is, it could be $1 billion business in the U.S. market, but they're often like kind of um, very fringe or niche opportunities that they're going after. Whereas what we love about a lot of these emerging markets, particularly Latin America, where we've been very active, is that a lot of the founders that we see are building like really important businesses in these places, like the banks, like the new banks of the region, or the Uber, or the logistics platforms or the FedEx, or it's like they're really building like major important infrastructure that is going to be, if they succeed, will become the most valuable company in the region. And so what's neat about being able to invest in a lot of these other places is there's just so much less capital to compete with, fewer incumbents to compete with. And so we can invest in like really talented founders at very reasonable valuations where they're literally trying to build the most valuable company in their country or their region. And so it's part of why we like investing in a lot of these places that are, I guess, geographically off the beaten path.
Absolutely. And how did you go about building this international network of scouts? How did you get in touch with these people who can source these deals for you?
Yeah, well, so we have we have LPs from all over the world, so they're a major source of deal flow in all these regions. And then as we start to invest in these places, the founders that are on the ground in Latin America or Africa or India, they have buddies that are also starting companies there, and they send us more opportunities as well.
Yeah, sounds great.
So once you get going, it builds.
Absolutely, yeah. And I saw that you are in many of the companies that you've invested in, you're either the first check investor or a pre-seed, or sometimes also the seed investor, right? So to be that early in a company, you have to be really careful about the investment that you're making, right? And on what factors do you evaluate a company when they haven't had any outside capital yet? So how do you believe in that investment? How do you prepare the memo? Like, what all factors do you look at in that particular company that hasn't raised any capital yet?
Yeah, sure. Happy to share. So I mean, first of all, I think step one is to embrace the fact that venture capital, anywhere you do it, is very risky. Like if you do it in the US and known founders, or even if you invest after lots of other investors, still half the companies are just not going to work out and lose your money. And that's just how it is. Like it's really hard to build a successful business. And so whether you do it in the US or you do it in an emerging market or anywhere off the beaten path, it's risky. And perhaps it's a little bit riskier to do it maybe further away from home where you don't know as many people or you don't know the market, but I don't think it's that much riskier. And uh, usually it's a different set of risks. And as they say, the only free lunch in investing is diversification. We like the idea of diversifying where we do have a bunch of US investments with one set of risks, investments that are emerging markets or different industries with a completely different set of risks. And when you put those together, we really like the kind of the construction of the portfolio that we end up with, where it's really everything's extremely uncorrelated, and it's a completely different sets of risks. So now, the first thing is the valuations relative to traction that we expect to see when we're investing outside the US are lower. And so we are typically paid for the risk that we're taking in those investments. Second, we don't totally just invest in some random person that we don't know anything about, that we have no connections to, and that we can't diligence. Almost every founder that we invest in is usually kind of a known person in some way. Either we know people well that can vouch for them, or the person has really relevant prior expertise where we can kind of, there's a way that we can reference check them and we know that they have that expertise. As an example, one of our really promising investments is a company called Jeeves. It's kind of a global business bank. It started in Latin America, but now it's everywhere. The truth is the founder there is a good friend of mine from business school. And, he went off the beaten path, but I know him. He's super smart. He had founded another company before that's very successful. And so it's just, in terms of him, it was an easy bet. I didn't know that this company was going to be as successful as it was, but it's just, he's kind of a known person. And although he's kind of going off the beaten path, it was an easy bet to make, if that makes sense. And as another example, like, we're invested in a company in Pakistan that does, it's kind of Uber Eats for Pakistan. The founder had previously created and run Uber's business in Pakistan, where once again, it's not just like some random guy that has an idea. It's like somebody that really has a track record in that market and has been very successful with that. And it's not to say any of these aren't risky. They're still startups. They may not work out, but at least the founders that we're investing in are usually kind of known people that have some kind of track record of success.
Great. And I would like to understand what kind of percentage stake are you looking for at these three different early stages, which is basically being the first check and then being a pre-seed or maybe a seed. So what is the kind of percentage stake you're taking at these stages?
Oh, we're not. So most VCs talk about these ownership targets that they need to hit, and we're not like that at all. So we both invest from our fund and we invest from our syndicate. And the dynamics of that is, we typically write 25 to 50K checks out of our fund. We aim for a large portfolio. We're currently pacing at about 150 investments a year. So we write relatively small checks and aim for a big portfolio. Some companies we only invest from our fund, sometimes only 25K. For companies that want us to engage our syndicate backers and run a syndicate to invest for them to invest more money, that is completely dependent on how much interest there is from our angels. So sometimes we'll put a deal up, we'll only get 100K of interest, and that's fine. Whatever that buys, as long as we're investing at what we think is a reasonable valuation, that's the ownership in the company we get. And then every now and then we have ones that are very popular. Like we're actually doing an investment in a company in India right now where the profile of the deal is very attractive to our syndicate angels, and we've raised about $740,000 from them, and there we'll end up with actually some real ownership in the company, and we're excited about that. But we didn't go in saying we need this. It's really both. It's based on the valuation the founder sets and how much interest there is from our syndicate angels.
Got it. But would you like to put a range to it? Like it ranges from maybe 5% to 10% at this stage and 10 to 20% at this stage. If you would like to give us some sense. If not, it's fine, of course.
Yeah, sure. So we have a few companies where we probably have somewhere in the range of 5 to 10% ownership, and that's very high for us. We have a lot of others where we either invested a small amount or invested later at a higher valuation, and it might be like 0.1% ownership. And the way we think about this is, so all of venture investing follows this power law distribution, where 1, 2, or 3 investments in the portfolio end up being worth more than everything else combined. And the key in this game is to really make sure that you're getting in on the biggest outliers you can. And so, as an example, Uber, the seed investment in Uber returned 5,000x into the IPO. And, obviously we can't guarantee we're going to get something like that in the portfolio, but the winners are just so big that even if you index across 150 or 300 or 500 startups, but you get one of those, you'll return 10, 20, 30x times all the money. And it's more important to just get a little bit and something like that, something that returns 5 or 10,000x, than it is to have, say, 10% ownership in a couple that return 100x. I mean, 100x is great, but it's so much smaller magnitude-wise than a 5,000x. So we're really just trying to make sure that we maximize the chances that we get in on 1 or 2 super mega outliers.
Awesome, pretty awesome. And I see that you have a syndicate and you also have a rolling fund operating. So I would like you to compare a syndicate model with a VC fund model, and what do you think are the advantages or disadvantages of the syndicate model in comparison to the VC model?
Sure. I think that they're actually more similar than a lot of people think. So in a conventional venture fund, you raise a certain amount of money, you go out, convince the LPs, you raise a certain amount of money, and then within your firm, you and all the other partners debate where to put that money. And so if you find an investment that you like, you have to bring it to your partners and you have to sell them on the investment. You have to do a lot of work and a lot of due diligence to convince them that this is one of the places that you should put part of your fund. With a syndicate, we don't have this huge, firm that we're operating. We don't have all these partners to sell. Our partners are actually our angel LPs that follow us. And once again, we find an opportunity, we do the due diligence, we write up a really good memo, and then we put it up in front of our partners that are our angel LPs in this case. And if they agree with the work that we've done, they agree to allocate their money to us, and we can make an investment. And so the dynamics, I think, it's kind of the same amount of work. But what I really like about a syndicate versus conventional fund is, one, as I mentioned before, we can leverage these syndicate backers in a lot of ways. They send us deals because they feel involved. In many cases, they actually help the companies that we invest in. And in contrast to a conventional venture fund where their LPs are maybe pension funds, endowments, like entities that are not going to be helpful at all to the companies. In every syndicate that we do, we get somewhere between 50 to 200 individuals who invest as angels through us into the companies. And some of them end up being very helpful to the companies in a lot of ways. And that value proposition that we're going to bring a bunch of individuals, including that are like execs or engineers at big tech companies or fellow founders and things that I guess that value proposition is really attractive to a lot of founders. So it's really neat to have this kind of, I guess the word is community or village of evangelists around us that are kind of keeping us in check, are checking our work. They only allocate money when we really bring a great deal and we've done the due diligence and they agree with the work we've done. But then it's really neat to have them involved in all these other ways too. That adds a lot of value to both our investing activities and the companies that we've invested in.
Yep, that's great. Besides, you just mentioned that for every deal, you're actually writing up a memo and then sending it out to the investors. So, talking about this memo, what goes into preparing this memo? On what all factors are you evaluating the company? What all sections are there in the memo? How big is the memo? Uh,
Mhm.
how is that memo prepared, and how much research goes into it?
Well, it varies a lot. So the main things that most VCs want to know about are, um, well, obviously what it is. So kind of understanding that, encapsulating it, and talking about why what it is important and potentially valuable. And then after that, we find that there are kind of three main things that a lot of LPs care about. It's the team, the traction, and what I call the social proof. And I'll explain what each of those is. So the team, it's who the founders are and why they are credible and likely to be successful. And when we're really making investment based on a team, I try to make the case that this might be the best team in the world to build this business at this time. And that either has to do with a track record of success or unique experience, or I'm looking for something that gives me confidence that even if a bunch of other competitors emerge, this team feels likely, or this founder feels very likely to succeed with this business. So that's team. Traction. Uh, Depending on the valuation that we're investing on, the traction matters more or less. And it's not necessarily revenue, although that matters. It's not necessarily users, although that matters. What we're generally looking for is something numerically extraordinary that's happening under the hood at the stage the company's at. So, we had an investment that we did a few months ago where the absolute numbers were not remarkable, but what was remarkable is that the company had started out, got 5 users, literally 5, and tailored this product just for them. And over a period of a year, these 5 users were using the product almost every day for a whole year, and they had no churn. And they intentionally were not trying to grow yet. They were really just trying to make sure that they had a product that a few people really loved. And it was so clear that they'd achieved that, even though the absolute number was small. The thing that was numerically extraordinary was the retention. And that was very relevant for the product they were trying to build. And so we got excited about investing in that company. The team was also impressive at the valuation they're raising on based on that. And so every business is different. And what I usually advise founders on the traction piece is like, try to achieve something that's numerically or extraordinary for the stage that you're at. And you want the thing that's most relevant to what you're trying to achieve. So anyway, that's kind of how we think about traction. And then the last one is what I call social proof, and it basically means it effectively means who else is investing, and that's my least favorite criteria that we look for, but it's something that's very important to a lot of our angels. Everybody, by nature, gets more comfortable with anything, including investment, if they know other smart people think it's a good investment as well. And so we usually do tend to get more money into our investments when we're not the only one investing, and there are other credible, smart angels or VCs that have also vetted it and also think it's a good thing. We like to try to come in before that. And we do actually, like, based on the due diligence we do, we often get a good amount of money when we're the first investor. But it's still something that matters to a lot of people. And so for some investments, the social proof, like the other people around the company, do make a big difference to our syndicate angels. But so those are kind of the main things that we're trying to encapsulate. It's what it is, team, traction, social proof, and then also encapsulate within what it is. It's like, is the market here really big? If they succeed, could this become a really valuable company? But those are kind of the main things that we dig into.
Got it. And more recently, you've also started investing through your rolling fund. So,
Mm-hmm.
to our listeners who are not very familiar with the rolling fund model, can you explain what is rolling fund and how investors can invest with you via that vehicle?
Yeah. Happy to share, and thanks for asking. So, a conventional venture fund, the way it works is that the VCs go out and raise as much money as they can, and then they invest that over 2, 3, or 4, maybe 5 years. And then once they've invested to that, they then go and try to raise another fund, and then they invest that over a period of time. So Angelus came out with a new innovation that's called a rolling fund. And it's basically a quarterly subscription investment firm where we don't go and raise every few years. We basically have LPs, investors, that subscribe with us, and each quarter they give us a certain amount of money. And we invest that money in the quarter, and then at the beginning of the next quarter, they give us another amount of money. And what's been neat about it is we never go out and do a big fundraising process. We're kind of like always fundraising in a way. We're always open. and people can come and go, where if someone hears about us tomorrow, they can come find us and start subscribing for the next quarter, and they become invested with us through all the investments we make over that period of time. We do add, just to make sure that we have some stable capital over a longer period of time, we actually lock people in for usually 8 quarters at a time, although people can opt to do less than that if they're willing to pay more fees. But in general, we want to both make sure we have stable capital, and also knowing how, knowing the power laws where our investment returns are based on outliers. We want to make sure that when people invest with us, they're invested over a long enough period of time that we're very likely to get them in on an outlier. If they come and go in one quarter, we don't get an outlier in that quarter, they might have bad returns. So we would really like them to be with us for at least 4 or 8 quarters, which is a period of time that we're confident we can get a big winner, and thereby deliver them really good investment returns. So anyway, that's a bit of a tangent, but the idea is it's kind of like an evergreen fund where people just subscribe with us as they would subscribe to a piece of software or a magazine, but they're subscribed to invest with us. And in contrast to the syndicate, it gives us some more flexibility to make investment decisions, so we can be quick. Some founders don't want to have a syndicate. They don't want exposure to so many people. They don't want information leaking. And so in cases like that, we can only invest from our fund. Sometimes deals are very competitive where we can only get a tiny allocation where only our fund fits in. And in other cases as well, we're trying to invest super early at often very low valuations, and there just isn't a story yet that would be compelling to all of our syndicate backers. And so with the fund, we can invest early like that where the story isn't fully clear yet, get that stake, and then as the company develops and the story becomes more clear, then we can present it and raise more money in our syndicate. So anyway, for all those reasons, we really like having the rolling fund, and we're really grateful for the support of a lot of our LPs who subscribe with us and let us deploy that money with a lot of autonomy. And in terms of size, it's about $7 million a year right now that we deploy through the fund.
Got it. Yeah, rolling fund seems to be like a very exciting model that's come up now. Besides, I want to talk about one of your early investments that is popular here in India, and I'm a user of that as well. It's called,
cool.
It's Zepto basically. So you were an early investor in Zepto, and the founders are really young folks. So, and the valuation of the company has gone up significantly ever since you invested. So I want to talk to you about how did you source this deal, then how did you do diligence for this company, because the founders are really young, so it would take a lot of courage to back them at an early stage with not a lot of prior experience, right? To build a company of this scale, which is a new business model in many ways, which is like about 10-minute, 5-minute delivery, and doing it well. They were probably the first ones to do it in India, and then others followed after them, right? So how did you source this deal? How did you trust them and back them? And what is the markup you've seen on this investment?
Yeah, so first of all, I can't take credit for this one. So this is actually my partner, Thibaut. So Thibaut is kind of the senior equal partner with me in Unpopular Ventures. We have a few other people that work with us part-time, but Thibaut is really my main partner in UV. And he gets all the credit for sourcing it and making the investment. And we feel incredibly fortunate to be a small part of their journey and along for the ride. So the markup, we invested at a $13 million valuation post money, and they've now raised on a $900 million valuation. I don't think I'm actually at liberty to share what the multiple is net of dilution. I think that's confidential information, but we've done very well with it. So my partner Thibaut is very good at kind of going through all of the Y Combinator companies and finding some of the most promising ones. And as I shared before, all of startup investing is risky. We opt for kind of a larger portfolio strategy where, by investing in more, if you only invest in 5 companies or 10 companies, you really want all of them to work. Each one, like you feel like you have to do a lot more due diligence to really make sure you get it right. When you're investing in 150 a year, it's okay if there's more risk or some of them don't work out, and we're very comfortable with that. And when Thibaut made this investment, the founders just seemed really smart. They had good traction already. They're on a good trajectory, and it just seemed like a really good bet. We weren't sure it was going to be this wildly successful company. We made a number of other investments at the same time that seemed similarly promising. And the founders at Zepto just really executed incredibly well and made the company wildly successful. We just feel very lucky that was one of the investments we made. Thanks to Thibaut.
Yeah, absolutely. They're doing incredible work and things much beyond their age, especially. So, besides talking about, you are staying on top, I believe you and your partner are staying on top of trends across multiple geographies. And what exciting startups are coming up? What are the exciting sectors that are coming up? And then sourcing these deals and then sending out these memos to your fellow investors. So, how much work does it take to stay on top of all these things and then send out the most exciting pitches that you get to your investors?
Yeah, well, the honest answer is I don't feel that we actually stay on top of that much. Um, a lot of VCs do try to be thought leaders. They're talking about new trends, and at least for me, I can't speak for all my partners, but for me, I don't think I'm actually that smart, and I cannot really see the future. But what I'm really good at is identifying really smart people that are onto something. And almost all of my investment decision has to do with the individuals and what they've achieved, and meaning the traction that they have in their business so far. And if they seem like someone that's going to be really successful with whatever they're doing, I beg them to let me invest, and that works for us. Going in, many of our most successful companies were in locations or sectors that I knew nothing about and had zero thesis on. So as an example, one of our very successful companies is a company called Yassir, which is it's a super app in Francophone Africa, which it basically means French-speaking Africa. It's 29 countries, about 430 million population. I knew nothing about Francophone Africa. I didn't know that like part of Africa was French-speaking and another part was something or like that you could even organize in that way. But there was a really smart founder that had incredible traction, and he was raising at a reasonable price. And it just seemed like a good bet, and we invested. And he's now been wildly successful, and raised at much higher valuations, has incredible traction. It's now one of the biggest businesses in the region, and I really could not have predicted anything about this being a successful business in the region. All I could predict was that this guy seemed pretty smart, was probably going to be successful. So that's all there is to it.
Absolutely. I love it. I love it. Absolutely. Besides, now I've come to the end of my main questions, and now we can get started with the rapid fire section, wherein I'll ask you 5 quick questions about the fund, about the syndicate, and the rolling fund, of course. And you have to give 5 quick answers. So can we get started with this?
Sounds great.
All right. So the first one is, what are the sectors and regions you invest in?
Yeah, we invest in everything. We generally I guess it's rapid fire.
Yep.
So we will literally invest in everything as long as it's compelling. We can make the case that the founder is likely to be, it has a good chance of being successful in a really big business, and it's a little bit off the beaten path.
Awesome. What stage you typically invest in?
Probably about 80% is pre-seed and seed, and then about 20% is kind of Series A and later.
Got it. What's the typical check size?
There's a big range. So the minimum we do is 25K, and we occasionally do investments as big as $1 million if our syndicate backers get really excited about it. I think right now in the current, our average check used to be about $250,000 per investment that we would syndicate. Now in the current market climate where everyone's feeling a little bit poorer, everyone's stocks and everything are down, we get a little bit less from our angels, but I think our typical check now is somewhere in the range of like 100 to 150K. In companies that we syndicate.
Got it. And where can founders apply?
So we don't have an application process. Most of the investing we do comes through warm intros. So if someone wants us to consider it, I'd recommend finding either another founder or one of our 3,600 LPs who's someone in common, and ask them to make an introduction to me.
Awesome.
Or to one of my partners.
Yep. And the last one is, where can our listeners follow you?
Yeah, I'm on Twitter. I don't post a lot, but I post occasionally as Unpopular VC. I'm on LinkedIn. And for people that want to consider investing with us, you can find me at unpopular.vc, which leads you to our Angels page.
Awesome. I'll make sure to put all those links in the show notes below. I love all the work that you're doing.
Thank you very much. I appreciate all your kind words and your time. Thank you so much for the opportunity.
My pleasure.